Hi everyone, welcome back to Saheb Academy. Today in this video we are going to start this new chapter, Issue of Debentures of accounting paper, and we are going to completely understand everything from basics. Okay, we're going to break this chapter in various videos. First we'll have a conceptual video to strengthen your basics regarding this topic and the entire overview, the entire idea, and then we'll start solving problems, right? And then we'll have various topics, subtopics of the chapter we'll cover video by video. Okay, that's how we do it. We always break the chapter in various parts and simplify everything, right? So that's what we are going to do with this chapter as well. So let's begin. Let's understand what is this issue of debentures. Now see, here we have the concept of issue of debentures. It's really simple and straightforward. The first thing that you should understand is what are debentures. Let me tell you, debenture is nothing but just a loan. It's same like a loan. Okay, so let's discuss this by taking this example. Let's just say, for example, there is this company, okay, who needs 10 crores. They are in need of funds. So what options do they have to raise that money? See, the first option you will say is to issue equity shares or preference shares, right? But let's just say maybe they don't want to issue shares. Okay, if they issue equity shares, then what happens? The ownership will be diluted, the control will be diluted, because shares have voting rights, right? So that's why they don't want to issue shares. The second option they have is to go to a bank to get a loan, and then use that money for whatever project they need it for, right? So if they go to a bank, what are the problems? What are the issues that they are going to face? Let's understand. If they go to a bank, the first thing is bank will ask for a collateral, a security, an asset, isn't it? Yes. And then the second thing is bank will charge high rates of interest. Okay. And the third thing is maybe this company is, not that much good reputed. The reputation is not so good, so that's why the company is not looking for a bank loan. This option is also not interesting for them. So the third option they have is to issue debentures. What does that mean? It means directly go to the public and ask for money as a loan. Okay, and they did that. They went to the public and they asked for money. Okay, so public gave them 10 crores. Public gave them 10 crores and the company promised to pay them back after 10 years. After 10 years, how much money? 12 crores, 2 crores extra. Okay, 2 crores extra. So that extra thing which they will pay will be called as premium. It will be called as premium on redemption. Okay, redemption means repayment, and that repayment will happen after 10 years. Is that clear? After 10 years. But everything has been decided right now only, in this first year only. How much will be paid back, when it will be paid back. Okay, all the terms and conditions will be decided at the time of issue only, when money will be received by the company. When the loan is taken. Is that clear? Okay, so all this will be written down on one piece of paper called as debenture certificate. Right now it will be digital. Okay, it will not be written. Fine, it will be digital. So on this piece of paper many things will be written. Okay, see, debenture certificate, there will be something called as face value, and then tenure. Tenure is 10 years, as I said. Company will repay after 10 years, isn't it? So tenure or period or the maturity period is of 10 years. And then interest rate, of course it's a loan. If there is a loan element, then of course there will be interest, isn't it? No one will lend you money without interest unless it's your family or brothers, right? Your friends, isn't it? So there will be interest. See here, 12% debentures. Public gave the money to the company. Company received the money and company gave them what? 12% debentures. This certificate, this piece of paper promising everything. After 10 years we'll pay you back 2 crore extra, isn't it? And then this 12% means the interest rate. Whenever you see 12% debenture, 13% debentures, 8% debenture, anywhere on internet, in news and all, wherever, then you have to understand that on that debenture, yeah, on that instrument, the interest that will be earned is this 12%, 13%, whatever it is. So interest rate will also be mentioned on this piece of paper. And then the redemption value. Redemption value means repayment value. Okay, how much will be paid back? Okay, there will be mentioned, it will be mentioned. And then maturity date, on which date the repayment will happen. That's called maturity date. Is that clear? All this will be mentioned over here. Now tell me, from the point of view of the company, what is this debenture? From the company's point of view, debenture will be their liability, isn't it? It will be their liability because they have received the money. Now this money has to be repaid back after 10 years. They have to repay. Yeah, have to pay. So that will be their liability. On the other hand, for the public, for the investor, this money, yeah, this debenture, this will be their asset because they have invested their money. So from their point of view, AS 13 will apply. Okay, investment accounting. Is that clear? Accounting standard 13. Fine. And they will receive interest on that. It will be their asset. Yeah, interest will be their income, isn't it? Yes, this is what will happen. Fine. So see here. Yeah, every year fixed interest will be paid to the public, 12%, as I said in this example. Mostly in India, what happens is every 6 months interest is paid. Okay, so 12% interest is there now. So 12% into 1/2. Yeah, every 6 months it will be paid. Fine. In India, it's like that, but it can differ from company to company. It can be yearly also, quarterly also. Okay, so 12% yearly interest will be paid. Okay, in this example, it can be 13%, 7%, 8%, 9%, whatever it is. And then, as I said, after 10 years, what will happen? After 10 years, the money will be repaid back, the original sum. Either it can be 10 crores only or more than 10 crores. It will never be less than 10 crores. Obviously, yeah. If you take a loan from someone, can you repay him back lesser amount? No, you can't. Yeah. You have to pay an equal amount back, or in this case, see here, they are paying 2 crores extra. Yeah, company received 10 crores and then company is paying back, let's just say 12 crores. Okay, so extra premium is being paid because for 10 years this public is waiting, right? That's why. Fine. So redemption is nothing but repayment, and this will happen on maturity. Fine. So this is the concept of debentures. So what are debentures? Debenture is a written instrument or document, a piece of paper issued by a company. Yeah, it is issued by a company under its common seal. Yeah, under its common seal, acknowledging a debt. Companies accepting on this first day, yeah, in this first year, that we are accepting that we have taken money from you and we will pay you back after 10 years. They are accepting this, acknowledging a debt, acknowledging a loan, and containing provisions as regards repayment of principal amount and interest. Yeah, I told you in the debenture certificate it will be mentioned how much interest will be paid, when it will be paid, right? And then when the original sum, the original amount, that 10 crore, when it will be repaid back, yeah, that will also be mentioned. Redemption value and maturity date, and many other details will be there. Fine. So this is what is debenture. Yeah, like how shares are issued and company will receive the money. Yeah, here also it's kind of like that only, but understand, in shares the money is not repaid back. I'm talking about equity shares. Money is not repaid back. Yeah, it will be repaid maybe on liquidation. Yeah, when the company will be closed, but normally money is not repaid in terms of shares. Yeah, equity shares. But in terms of debentures, this is same like loan. So this money has to be repaid back. Okay, 100% it has to be repaid. So that is why in the beginning only everything will be decided. How much interest will be paid every year, and then how much will be repaid, the original sum, everything will be decided. Okay, so this is the thing. So let me just show you now the features of debentures. See here, features of debentures. Fixed income bearing security. Yeah, from the point of view of the public, for them, for the investor, this is what fixed income bearing security, because if they subscribe to these debentures, then every year fixed amount they will get as an interest, 12% interest. Okay, fixed income bearing security. And then the second feature, interest is paid on due dates. Yes, as I told you, there will be dates, okay, every 6 months or every quarter, however it is in the company, okay, it differs from company to company. So interest will be paid on due dates. Fine. And then the third is document which evidences a loan made to a company. Yes, this debenture certificate, it is an evidence. Yeah, it is a document which evidences that the company has taken a loan and company is promising to pay it back after a certain period, yeah, on maturity date. And then the fourth feature, see here, original sum is repaid at specified future date. Yes, at maturity date, the original amount will be paid back. 10 crore they received, they are paying back 12 crores, as I said. Okay, it's like that. And then see here, or it is converted into shares. Yes, there are also something called as convertible debentures. Okay, see, there are, on the basis of convertibility, there are two types of debentures. Okay, convertible debentures and non-convertible debentures, right? So in convertible debentures, you have partly convertible and fully convertible. Fine. So these type of debentures are there. So if those types of debentures have been issued, then the investors, yeah, these investors who have subscribed to the debentures are called as debenture holders. Okay, debenture holders. So debenture holders will have a right, will have an option to convert into shares also, equity shares, if they want. Fine. They will have an option in such kind of debentures. I told you now, partly convertible or fully convertible. Fine. And then the fifth feature is traded in stock exchanges. Let's just say, for example, let me explain this to you. Let's just say, for example, you subscribe to the debentures of a certain company. Okay, you invested, let's just say, 1 lakh money. You purchased many debentures, you invested 1 lakh money, and then let's just say some emergency happened at your home, and you want your money back, you want your 1 lakh back. So what are you going to do? Can you go to the company and ask for the money? See, company, I am in emergency, yeah, I need funds, so please give me my money back. No, it doesn't work like that. The company has already promised to pay you back after 10 years, right? And you have agreed to the terms and conditions. So you will not be able to get money like that from the company directly. No, what you will have to do is you will have to go to a stock exchange. It is compulsory, for every company, that if they are issuing debentures, then they have to list their debentures in any one of the stock exchanges, right? So if you go to the stock exchange, then there will be another investors, there will be public who will be ready to buy off the debentures from you. They will buy off the debenture certificates from you. Okay, and you will get your money, whatever the market rate will be prevailing, at that rate you will get your value. Is that clear? So you can sell your debentures in open market, in stock exchanges, and get your money back. Fine. So debentures are traded in stock exchanges. Is that clear? Simple and straightforward. The next feature, see here, no voting rights. Yes, as I told you, equity shares have voting rights. Yeah, when equity shares are issued, the ownership gets diluted. But when the company raises debt, when company raises funds through debt by bank loan or debentures, what happens? Ownership is not diluted because there are no voting rights. In debentures there are no voting rights. Is that clear? It's just a loan. These are not shares, so no voting rights. Is that clear? Simple. And then see here, 7th point, interest is payable at predetermined fixed rate regardless of the level of profit. Yes, I told you in the beginning only it will be decided what rate of interest will be paid, and it is fixed. It will not change. Every year 12% this company has to pay. Okay, is it clear? Yes. And then regardless of the level of profit, it doesn't matter. It doesn't matter whether the company has made profit in a certain year or not. Okay, it doesn't matter. It's not shares like how you give dividend out of profit. No, it's not like that. This interest payment is a charge against profit. It doesn't matter whether you have profit or not. You have to pay the interest. I mean, the company has to pay the interest. Is that clear? Simple. Fine. So regardless of the level of profit, the company has to pay the interest. Next point is, see here, 8th point, generally issued for more than 5 years. Normally debentures are issued for a long period. Okay, 3 years, 5 years, 7 years, 8 years, 10 years, and some companies are even allowed more than 10 years also. Okay, so it's issued for longer period. Okay, fine. And then see here, yeah, so because of that, this will be called as what? Long-term debt instrument. It's a long-term debt instrument. Okay, and in balance sheet, the company will have to take this under where? The company will have to take it as long-term borrowing, because it's a borrowing. It's a loan, right? But it's not short-term, it's long-term borrowing. Yeah, it's a non-current liability. Is that clear? That's how it will be taken under the balance sheet of the company. So now let me tell you one important point. See here, now we are doing which chapter? We are doing chapter called as Issue of Debentures, right? So when you will learn this chapter, you have to only think from the point of view of the company. Okay, when you will see percentage debentures account, you have to understand this is our liability. We are company. See here, we learn this chapter from the point of view of the company that issues the debentures. Okay, we will do the accounting in the books of the company, right? Issue entries and everything. So always think from the point of view of the company. Debenture is your liability. Is that clear? Right. When you will learn investment accounting, that separate chapter, yeah, in that you have to think from the point of view of public, yeah, from the point of view of the debenture holder. But right now in this chapter, from the point of view of the company. Fine. So yeah, this is the concept of issue of debentures. Now let me just give you a chapter breakdown and let me tell you what all things we have to learn in this chapter. Now see here, we have the breakdown of this chapter, issue of debentures. Let me quickly take you through this flow chart and explain you what are the different topics that we are going to cover in this video series and what you have to learn in this chapter. See, the first topic is issue of debentures. And let me tell you, debentures can be issued for cash, for consideration other than cash, and just as a collateral security also. Okay, the first is this main topic, and this is what we are going to cover. And in this subtopic, we have 6 different ways in which debentures can be issued. Debentures issued for cash means company is in need of funds, right? Company goes to the public, issues the debentures and gets the money to finance their projects. Okay, like how we saw in the conceptual example, the company was in need of 10 crore funds. So it went to the public, issued the debentures, got the money and financed its projects, right? So in this, we have 6 different ways in which debentures can be issued. Debentures can be issued at par and redeemable at par, issued at par and redeemable at premium. Okay, and the same thing in all of these cases. Okay, debentures can be issued at premium, redeemable at par, issued at premium and redeemable at premium, issued at discount, redeemable at par, issued at discount and redeemable at premium. What does redeemable means? Redeemable means repayment, repayable at par, repayable at premium. Okay, after 10 years, how you're going to pay back, that will be decided beforehand itself at the time of issue only. So those things are also considered while doing the accounting treatment, while passing the journal entries of issue of debentures. Do you understand? While passing the journal entries of issue of debentures, at that time only you have to consider the element of repayment, because you exactly know what will happen after 10 years, after 7 years, or whatever the maturity period is, because everything will be decided. What's the repayment value? Yeah, what's the redemption value? Everything will be decided beforehand itself. So that's why in this main topic we have 6 different cases. Don't worry, I will teach you. It's really simple. Okay, and then debentures can also be issued for consideration other than cash, which means here we are not getting money, company is not getting money, company is getting assets, or maybe company is purchasing, another businesses, right? Other businesses. So if the company is doing that, then in purchase consideration, they can give debentures. Okay, we'll learn this. And then collateral security. Yes, debentures can also be issued as a collateral security, which means that, let's just say, for example, company has taken a bank loan. Now banking asking for a security. So what we do is, we can issue secured debentures to the bank just as a security. We will not pay interest on those, debentures and all. It's just for security. If we default on the bank loan, then they have a security, which are secured debentures. Okay, right. So that's the thing. Okay, we'll learn about this in the coming video, these 2 topics. And then we have interest on debentures. We have to understand how interest is paid, how it is calculated, what are the journal entries we have to pass. And in this we have a topic called as tax deducted at source, TDS. Okay, on the interest which we are going to pay to the debenture holders, yeah, to the public, on that interest payment there will be tax deducted at source. So that also we are going to study, and the journal entries and everything. Okay, don't worry, it's simple. And then understand, here we'll have something called as discount or loss on issue of debentures. Okay, and this will happen only in 3 cases. Understand this properly. Okay, this thing, discount or loss on issue of debentures, this will arise only in 3 cases. That is, issued at par and redeemable at premium. Issued at premium, redeemable at premium. Issued at discount and redeemable at premium. Okay, whenever redemption is at premium, we will have what? Discount or loss on issue of debentures. Okay, and this is a capital loss. Understand, this is a long-term loss, capital loss. So we'll have to first capitalize it, we'll have to record it in the balance sheet, and then we'll have to amortize it. We'll have to write it off over the period of the debentures, over the life of debentures, or the tenure of debentures, you can say. Okay, that's called writing off. Writing off means cancelling off. Fine. And we'll do this by straight line method or sum of years digit method. Okay, we'll see that in the coming videos, but this is the basic idea. Okay, this is what we are going to cover in this video series. Is that clear? Right, now let's move on. Let's understand what is face value, issue price, and then redemption value properly with an example. Now see, here we have the concept of 3 values that we have in this chapter, which are very essential for you to understand: the face value, the issue price, and the redemption value. Okay, so let's understand these 3 in very much detail with the help of this example. Let's just say there is this company which needs 10 lakh rupees to finance one of its project. Okay, 1 million rupees. So what it does is it issues 10,000 quantity number of debentures to the public, and the name of the debentures are 12% debentures, which means 12% interest per annum will be paid to the public. Is that clear? Simple. And then they are saying, see here, issues 10,000 12% debentures of rupees 100 each at rupees 100 redeemable. What does redeemable mean? Redeemable means repayable at maturity, repayable at a premium of 30% after 10 years on the date of maturity. Is that clear? Okay. So in this sentence, they have told you the quantity of debentures, the interest rate of debentures, and then the face value, the issue price, and the redemption value also. Okay, and the maturity period also they have told you, right? All these details is given in that sentence. So now you have to understand what's the face value over here. Face value is rupees 100. See here, they are saying debentures of rupees 100 each. Yeah. Now, what is this face value? How did we come to know its face value? Because they told it in the beginning, see properly, of 100 each. They are of 100 each. That's the starting point. Understand, face value is the original value. Yeah, you can call that as original value or nominal value or par value. Okay, it's the starting point, initial value. Fine. And interest will always be calculated on the face value. It's very important for us. And face value is the barometer. Okay, we compare the issue price, the redemption value with the face value to know whether it is at premium, at discount, or at par. Yeah, face value is the barometer. We always compare these things, issue price and redemption value, with the face value. Okay, we'll see, don't worry. Now, face value can be anything. It can be 1 rupee, 2 rupee, 3 rupee, 5 rupees, 6 rupees, 7 rupees, 100 rupees, 1000 rupees, 500 rupees. Okay, it can be anything. Whatever face value is set, it is set in the beginning. Okay, it is set in the beginning as a starting point. It's the initial original value, and then we do the comparison with the issue price and the redemption value to know whether the issue price is at par, at premium, or at discount, to know whether the redemption value is at par, at premium, or at discount. Okay, how will we come to know this? By comparing it with the face value. Okay, let's understand. Now this company, yeah, what it did, the debenture of 100 each, face value 100, it issued that at rupees 100. Okay, company issued the debenture at 100 only, equal to face value. Okay, so now this 100 is the money that will be received by the company on a single debenture. Understand this. 10,000 debentures are there, isn't it? So see, 10,000 debentures into 100, yeah, all of the debentures will be subscribed, let's just say, then 10 lakh money will be received by the company. So public will subscribe. Some people will buy 500 debentures, some people will buy 20 debentures, whatever it is. Okay, however it is, they will buy, and what will happen? Entirely the company will receive 10 lakh money. Yeah, that's what happens. Fine. So now this issue is called at debentures have been issued at par. Why issued at par? Because the issue price is equal to the face value. Let's just say if issue price was more, if issue price was, let's just say 150, 50 rupees extra, yeah, if it was 150, then it is called as debentures have been issued at a premium. Yeah, we have received 150 rupees per debenture, right? So 50 rupees is the extra, that extra 50 rupees is called as the premium. Okay, 100 rupees is the face value, and that 50 extra which we have received, that's called premium. Okay, if it would have been like that. Okay, fine. So this is the issue price. So what do we do? We always compare the issue price with the face value to know whether the issue price is at par, at premium, or at discount. Is that clear? Fine. If let's just say issue price is at 80, let's just say, then we compare the 80 with the face value 100, and we come to know 20 is the discount. 20 is the discount. Now, when does the company issue debentures at a premium? When company is doing very well in the market. Company has huge profits, yeah, the reputation of the company is very good. Then at that time, what the company does is company issues the debentures at a premium at 120, 130, 140, okay, higher than the face value. Premium means just higher than the face value. Fine, simple, understood. And then see here, in this example, issued at 100 only, it's equal only, issued at par only. Okay, fine. So 100 rupees will be received by the company per debenture, and that's the issue price. Now, what is redemption value? See, at the time of issue only, I told you everything will be decided. How much money will be paid back at maturity. So it was decided repayment, redemption will happen at 130 rupees per debenture. Okay, 130 rupees per debenture. So this is the redemption value. The money that company is going to pay back to the public at maturity. Okay, is that clear? See here, amount received per debenture, and redemption value is amount repaid per debenture at maturity. So you see this, how much extra is being paid over here? 30 rupees extra is being paid over here. Yeah, 130 we are paying back. So 30 rupees is a loss to the company. 30 rupees is a loss to the company, and that loss will be recorded at the time of issue only. Understand that? Okay, we'll see that, don't worry. So you understood what's the face value, issue price, redemption value, amount received per debenture. This is amount repaid per debenture at maturity date. Is that clear? And let's just read this face value. Face value is the original value of the debenture specified in the debenture certificate, also called as the nominal value or par value. Fine. And interest of debenture is always calculated on face value, and face value can be of any amount. Okay, 1 rupee, 5 rupee, 10 rupee, 500, 1000, 100, anything. Okay, whatever face value is decided, after that you check them with the issue prices and redemption value. Is that clear? Okay, fine. Now let me tell you, see here, receipt of money while issuing debentures. Yeah, as I said, debentures were issued at 100 rupees. Yeah, so now this 100 rupees can come at once also from the public, or maybe in installments. Okay, both the things can happen. It depends how the company is going for. Okay, see here, receipt of money while issuing debentures can be in lump sum all at once. Okay, when the public will subscribe the debentures, yeah, when they will get the prospectus, okay, the book about the company, they will read about the company, and they will subscribe to the debentures by filing the application. At that time only they can pay rupees 100. Okay, this can happen if the company is going for this, or if the company is going for installments, which means the money will be received in installments by the company. On application 30 rupees, on allotment rupees 50, on first call rupees 20, or maybe there will be two calls, 10 rupees on first call, 10 rupees on the second call. Okay, it can also happen like that. Okay, you have seen this in issue of shares chapter, isn't it? The same thing, either all at once or in installments. Fine. Now to understand the journal entries and all, we'll assume that money is being received all at once, so that you can understand the journal entries better. But while solving the question, you will have this sort of questions also, so at that time we'll cover that. Okay, I mean, it's the same thing, only it's just little bit variation will be there while passing the journal entries. Fine, don't worry. Now I want to explain you the debentures can be issued in 6 different ways, as I told. See here, let me show you. Debentures can be issued in 6 different ways. See, let's just say debenture face value is rupees 100. Yeah, here also it was 100, so in this example also it's 100. Okay, if the debenture is issued equal to face value at 100 only, then we say that debenture is issued at par. It is equal with face value at par. Par means equal. Okay, right. And then at the same time, as I told you, this is a loan, right? So at the same time, the repayment terms and condition are also needs to be mentioned in the debenture certificate only. So at that time only, what will happen is the repayable thing will be mentioned. So let's just say redeemable at par, repayable at par only after 10 years. So rupees 100, see here, okay, equal to face value. This is the issue price and this is the redemption value. Okay, do you understand? Issue price, redemption value, amount received per debenture, amount repaid per debenture at maturity. This is the amount received per debenture, this is the amount repaid per debenture at maturity. Yeah, both of them are equal to face value, so at par, at par. Let's just say issue of debentures at par but redeemable at premium. At premium means extra amount will be repaid. Okay, extra amount will be repaid back to the debenture holders. 20 rupees extra. So you see this, how did I come to know it's extra? Because I compared this 120 with the face value. Okay, 20 rupees extra I came to know, that's how. Fine. Then see, these are the two cases. Okay, issue of debentures at par, redeemable at par, and then redeemable at premium. You cannot redeem the debentures at a discount. Understand that. Never. Okay, never it will happen. Because understand, you have taken a loan of 100. How can you repay back 80, 90, 70 rupees? You can't do that. Okay, it's completely messed up. Okay, that will never happen. Then see, issue of debentures can be also at premium. What does that mean? It means more than face value. Face value is rupees 100. So if the debentures are issued at 110, let's just say for example, yeah, then we'll say issued at premium. Even if it is 101, 1 rupee premium. Is that clear? Okay. And then same, redeemable at par and redeemable at premium. If it is equal to face value, then we'll say redeemable at par. If it is more than the face value, then redeemable at premium. Is that clear? 120. Yeah, this is equal to face value, this is more than face value. Okay, this is issue price, this is redemption value, and this is also redemption value. Is that clear? Case 3, case 4. Now this situation will happen only in books. Okay, just theoretical situation where you have taken a loan of 110. Okay, and then you are repaying it at 100. It's not discount, it is equal to face value. It's just there in the books. Okay, it's just hypothetical situation, theoretical situation. Is that clear? Okay, fine. And then you have, see here, at discount. What does at discount mean? What does at discount mean? Face value is 100, face value is 100, and you're issuing the debentures at rupees 90, less than the face value, 80, 90, 70, whatever it is. Okay, and then redeemable at par. If it is redeemable at par, then the redemption value should be equal to face value, isn't it? Redeemable at par, issue at discount and redeemable at par, and then issue at discount and redeemable at premium. See here, it's more than the face value, 120. Yeah, 20 rupees extra is being paid. Yeah, we receive 90 at the time of issue and then we are paying back 120. Okay, all this can happen. Yeah, 20 rupees extra we are paying. So now you have to understand one thing properly over here. As I told you, whenever we redeem at premium, here, what happens? We'll have loss on issue of debentures. Okay, here we are paying extra now. See, we are paying extra at the time of repayment. So we'll have loss on issue of debentures in these three different cases. So journal entries will be little bit difficult. Okay, don't worry, I will teach you exactly how to do, but it will seem little bit difficult to you. Okay, don't worry, it's simple, it's really simple. Now what we have to do is we have to understand each of them, each of the cases, okay, and the journal entries, how it will be passed, right? So let's do that. You understood this, right? The face value, how you have to compare and get to know whether it is at premium or at, you know, discount or at par. Everything you can understand easily. Face value is the barometer. Now let's just understand the case 1 journal entry. Okay, let's begin. Now see here we have the journal entries of issue of debentures, and we are going to go by case as we have 6 cases, right? But first we have to understand the technique properly. Okay, see here there are 3 simple cases and 3 little bit complicated cases. Okay, so for the simple cases it's really easy. Directly you will pass the normal issue entry and it will be very easy. Okay, I will teach you. The problem arises in 3 cases, 3 bit complicated cases. See here the case 2, the case 4 and the case 6, in which what is happening, the redemption is happening at premium. Yeah, issued at par, redeemable at premium, issued at premium, redeemable at premium. Yeah, issued at discount, redeemable at premium. So whenever redemption is at premium, case 2, case 4 and case 6, what happens is we will have redemption elements. Redemption elements means loss on issue of debenture will be there because we will be paying extra, right? Yeah, we'll have to pay extra in future. So because of that, there will be loss on issue of debenture. Okay, and at the same time, a liability also, premium on redemption of debenture, because in future we have to pay. Yeah, in future we have to pay. So there is also liability because we follow double entry system, isn't it? Redemption element means we'll have to pay extra because redemption is happening at premium. So that extra thing which we will pay, there are 2 aspects of that in double entry system. First is it's a loss which has to be debited, and the second thing is it's a liability which needs to be credited. Okay, so that's the thing. So this thing we have to consider. Fine. So in those 3 difficult cases, what we'll have to do is first pass normal issue entry, and then we have to insert the redemption elements, this debit and this credit. Is that clear? Okay. Yeah, see the note 1, redemption elements comes into the picture only when debentures are redeemable at a premium. Is that clear? Yeah, case 2, case 4 and case 6. Is that clear? Only in these 3 cases. The rest are very simple. Okay, and then replacement trick. If you have learned issue of shares chapter, then it's really simple. The journal entries are exactly same like issue of shares. Okay, exactly same. It's just that you have to follow this replacement trick, which is just replace the share word with the word debenture and the equity share capital word with percentage debentures. Okay, it can be 12%, 13%, 11%, whatever you have in the question. Okay, you just have to replace this and you are, good to pass all the journal entries. It's just that redemption elements extra thing is there which we have to understand properly, and we will do that easily. Is that clear? So this is the technique for journal entries. Now let's begin with the case 1. See here, case 1 is debentures have been issued at par and redeemable at par. It's very simple. Face value is 100, issue price is also 100, and redemption value is also 100. See here, face value 100, issue price 100, redemption value also 100. Case 1. In case 1, see the same like issue of shares. Yeah, first what will happen, and we are assuming that all the money has been received in lump sum at once only. So with the application, with the debenture application, all the money has been received. So see here, bank account debit to debenture application account. Yeah, bank account is an asset account. Yeah, the company has received the money from the debenture holders, right? So 100 will be debited in the bank account, and then debenture application account will be credited. This is just a dummy account where we park our money for some time, and then we'll have to eventually transfer it to the, in issue of shares, you used to transfer to where? You used to transfer to equity share capital account in issue of shares chapter. Here you will transfer it to percentage debentures account. Okay, this is the liability account. In issue of shares chapter, this was equity account. Now here this is liability account where we have to transfer that. See, it's really simple. For transfer of application money to debentures account, what you have to do, this credit which you did over here, debenture application, you have to debit that and cancel the debenture application account and then transfer that to percentage debentures account by crediting it. Okay, and always remember, in this only face value will go, like how in issue of shares chapter in equity share capital, when passing the journal entries, only face value used to go in equity share capital. Similarly, exactly here, only face value will go in percentage debentures account. Is that clear? This is a liability account. Now understand, I always pass the journal entries with the modern rules of debit and credit. Yeah, isn't it? Bank account is an asset account. Yeah, we got the money. Yeah, you can say money is coming in, you have debited, but I say bank account is an asset account. Yeah, my bank account has increased, my bank balance has increased, asset has increased, I debited that. Is that clear? And then it happened because of debenture application, so that was the credit. Fine. And then I cancel that. Here I credited and then I debited and canceled that, and then I credited the percentage debentures account. Now this is a liability account. I told you debenture is a liability for the company. So what's the rule for liability? Liability has credit balance. Whenever it increases, you have to credit. Yeah, liability increased. There was no debentures earlier. Right now debentures have been created in the accounting books, so you have to credit it. Okay, liability has increased, you credited that. Is that clear? So this is the journal entry for case 1. Really simple and straightforward. Yeah, in the above entry, it is assumed the entire money, the entire 100 rupees is collected at the time of application itself. Now in the whole question, what will happen? You will not have 100 and all. Okay, you will have quantity of debentures which you have to multiply. 100 into 10,000 debentures, 100 into 5,000 debentures, like that. The whole amounts will come. Here to explain you the format, the concept, the logic, I'm just using small direct values, the prices only. Okay, just to make you understand. If the monies are collected in installments, application, allotment, calls, etc., then the journal entries are similar to that of issue of shares, and we'll see that while solving the problems. Don't worry. Okay, here we are just understanding the concept. Understanding the concept is very important. Okay, so this was the case 1, really simple and straightforward. Application money received, and then application money has been transferred to the liability account. Is that clear? Easy. As you can see, the replacement trick. See here, yeah, in issue of share chapter, what used to happen? Here share application used to be there. Yeah, the share word has been replaced by debenture application, isn't it? Yes. And see here, equity share capital used to be there in issue of shares chapter. You have replaced that with percentage debentures account. Is that clear? Simple and straightforward. This is the case 1. Let's move on to the case 2. Now see here, we have the case 2. Debentures have been issued at par and redeemable at premium. Let's just say, for example, the face value is rupees 100. Then the issue price also needs to be 100 only, because it is issued at par, equal to face value. And then redeemable at premium means redemption value has to be more than the face value, 120. 20 rupees extra will be paid back to the debenture holders in future after 10 years, for example. Okay, so this is case 2. If we see this on the flow chart, see here, face value is 100, issue price is 100, but the redemption value is 120. Okay, is that clear? Issued at par, redemption at premium. Okay, redeemable at premium. Is that clear? This is the case 2. So how are we going to pass the journal entries? It's really simple. The same assumption. Okay, it is assumed the entire money is received at the time of application itself. Yeah, so for receipt of application money, what we have to do? All the money has been received. Now tell me, which amount will be received? 120 or 100? Of course 100. Yeah, issue price is the amount that we receive per debenture. Is that clear? Keep that in your mind. So bank account, you will have to debit by 100, and we receive this money because of debenture application. Yeah, so 100. Is that clear? Simple. Bank account is an asset account, it increased, so you debited that. Then you have to transfer this money to where? To the main liability account of debentures, which will be recorded in the balance sheet. Yeah, so percentage debentures account, you have to transfer that. So here you credited this debenture application, you have to cancel that account. Okay, but understand here, first let's go to the technique and understand properly, because here there are redemption elements. Yeah, in case 2, case 4 and case 6 there are redemption elements. Yeah, because redemption is happening at premium. So what you have to do, you have to follow the technique properly. First pass the normal issue entry, how you did in the case 1 now. Simple. Yeah, this thing only you will have to, debenture application to percentage debentures. Okay, see here, Let me show you. Debenture application account 100, yeah, you will debit that and you will credit what? Same like case 1, you will credit percentage debentures account. Only face value will go in percentage debentures account. See here, percentage debentures account, face value will go. Simple entry, 100, 100. You understood this? Easy. Then what you have to do is you have to add the redemption elements. Yeah, what redemption elements? See, understand properly. In the beginning, right now, only at the time of issue, you know how much you are going to pay back. How much you are going to pay back to the debenture holders? 120. 100 is fine. 20 rupees extra is a loss for the company, isn't it? Yes, it's a loss for the company, and you definitely know right now that it is a loss and it will happen definitely in future after 10 years. So by following the conservatism concept, yeah, prudence concept, you have to record that loss right now, right here only. Okay, you have to book that loss right here. That is why, you know, we have these redemption elements. Loss on issue of debentures, which is rupees 20, and there is a liability account as well, premium on redemption of debentures, because that 20 rupees will have to be paid in future. So that liability also we have to book right now only. Why? Because understand, we record everything by double entry system. Yeah, we can't just record loss and not the liability. So we have to record both the things. Yeah, one is the loss that company has to bear, that 20 rupees, and at the same time that 20 rupees will have to be paid now in future to the debenture holder. So that will also be recorded. How will you record a loss? Loss is an invisible expense, right? To record a loss, what you have to do, you have to debit, right? It has debit balance, isn't it? And then premium on redemption of debenture is a liability which has credit balance. To record that, you will have to credit. Is that clear? Yeah, so that's what you have to do. So the simple journal entry for this will be loss on issue of debentures account debit rupees 20 and premium on redemption of debentures account credit rupees 20. Is that clear? Simple and straightforward. Okay, this is a capital loss, this rupees 20. So see here, loss on issue of debentures account debit rupees 20 to premium on redemption of debentures account rupees 20. Is that clear? Did you understand this? Capital loss you are recording. To record the loss, what do? You debit it. Yeah, I explained you through modern rules of debit and credit. Yeah, according to the golden rules, debit all losses, isn't it? And credit all income and gains. Nominal account rule. That rule is applicable over here. And then see, to premium on redemption of debenture, this is a liability. Yeah, this is a liability account which will be recorded in the balance sheet. Is that clear? Fine. And this loss will also be recorded in the balance sheet, but it has to be written off over the life of the debentures. As we said, 10 years. So in 10 years, we have to write it off slowly. Like depreciation, we have to amortize this. Okay, this is not a physical asset. This is just a, a loss. So this loss is amortized. Is that clear? It will be written off slowly, year by year. Is that clear? It's a capital loss. How is it capital loss? Because it doesn't happen normally. It just happens because of this. Yeah, one-time event, right? And it's related with the debenture. Debenture is going to last for 10 years. So this loss will also be written off over the life of debentures. Is that clear? Simple and straightforward. We'll discuss that. Okay, writing off at last. Don't worry. I mean, in coming videos. Okay. So these were the entries of case 2. Easy. It's really simple. Don't worry. Okay, just follow the technique. First, just pass the normal issue entry as I explained, debenture application to percentage debentures, and then just put this in that entry. These two things, redemption elements. Fine. And this will happen only in case 2, case 4 and case 6 when redemption is at premium. Is that clear? Simple and straightforward. You understood this. Okay, let's move on to the case 3. Now see here we have the case 3. Debentures have been issued at premium and redeemable at par. Okay, this is also a very simple case because here redemption is not happening at premium, so there are no redemption elements like loss on issue of debentures or premium on redemption of debentures. Okay, so if we see this, see here the face value is rupees 100, let's just say, and then the issue price will be more than the face value. Why? Because issued at premium, so IP has to be at premium more than the face value. Yeah, 10 rupees extra we will receive from the public, from our debenture holders. Is that clear? Yeah, 10 rupees extra we will receive, and then the redemption value is equal to face value only. we will pay back after 10 years the face value amount only, redeemable at par. Okay, nothing more, nothing less, just equal to face value, redeemable at par. Is that clear? So if you see this in the flow chart, see here, face value 100, issued at 110, issued at 110. So per debenture we will receive 110 rupees from the public, and redeemable at par, rupees 100. We will pay back only rupees 100, the face value. Okay, so how are we going to pass the journal entries? It's really simple. Okay, same like issue of shares only. See here, for receipt of application money, the same thing, bank account to debenture application. You already know the logic and everything, yeah? But understand what amount, not 100, not face value, remember that. Okay, IP. Okay, we will receive IP only, issue price only, because we have issued it at 110. So 110 per debenture we are going to receive from the public. Is that clear? Okay, fine. And then this 110 has to be transferred. Yeah. So how are we going to transfer? I told you we only transfer 100 rupees to the percentage debentures account, isn't it? Previously, as you saw in case 2 also, in percentage debentures account only face value went, only 100. Yeah, in case 1 also, if you see, in percentage debentures only face value went, rupees 100. But here, as you can see, there is face value as well as something extra, 10 rupees extra is there. So what is that extra thing? That extra thing which we have received is called as capital profit. Let me just explain that to you. See here, let's just say for example issue price is 120 and face value is 100. So that 20 rupees extra which we have received over here, that extra amount received is called as capital profit. Okay, we have received it. Okay, we have received it already. So bank account will be debited. Yeah, you know that. Yeah, if we just talk about this separate entry, bank account will be debited, and then that extra amount will go to a special account called as securities premium, and this is a reserve. This is a reserve. Okay, and you cannot use securities premium for any other purpose. Just like that, you have to follow the Companies Act. Okay, it is restricted. Okay, so that's the thing. It will go to securities premium reserve. Is it clear? So see here, the entry will be like this. Debenture application account will be cancelled. Yeah, 110 you credited over here. You will debit it and cancel it. Fine. And then you will transfer the money. Okay, only face value will go to the liability account, percentage debentures account, 100. Remaining extra which we have received, it will go to securities premium account. Is that clear? Securities premium account, rupees 10. Fine. So you can see percentage debentures account is a liability for the company. Yeah, it is getting created, it is increased, so we credited that. Yeah, because it has credit balance. And securities premium is an equity account. Yeah, it's a reserve, but it's an equity account. It falls under equity category. Okay, it falls under equity category which has credit balance and it is increasing, so you have to credit that. Is that clear? Simple and straightforward. Okay, so always remember, whatever extra we have received, it's capital profit and it will go in securities premium. Is it clear? Simple and straightforward. You have understood the case 3 as well. Now let's move on to the case 4. Now see here, we have the case 4. Debentures have been issued at premium and redeemable also at premium. Fine. So let's just say the face value is rupees 100. Then the issue price is, let's just say, 110. Obviously more than the face value because issue is happening at premium. Issue price has to be at premium, right? And then redemption value is at 120. Fine. Redemption is happening at premium. So 120, 20 rupees extra. Here 10 rupees extra we are going to receive issue price. In redemption value 20 rupees extra we have to pay in future after 10 years. We haven't paid that. Okay, keep that in mind. Fine. So if you see that in the flow chart over here, face value rupees 100, issued at premium 110, and then redeemable at premium 120. So this is the case 4. Is that clear? Simple. So let's begin. Let's understand how the journal entries will be passed. The same assumption, entire money will be received in application only. Okay, so for receipt of application money, tell me which amount will be received. Of course, the IP. right? Bank account to debenture application 110, right? After this, the second entry is transfer entry. You transfer the debenture application to the percentage debentures account and you record any redemption elements if there are any. Yeah. So in this case, tell me, are there redemption elements or not? Of course, there are redemption elements. Why? Because redemption is happening at premium. It is redeemable at premium, right? So whenever redemption happens at premium, what will happen? What will happen? There will be loss on issue of debentures, which we have to debit, and there will be premium on redemption of debentures, which we'll have to credit. But before doing this, what you have to do? You have to pass the normal issue entry. You have to pass the normal issue entry. So just see the case 3. In case 3, what did we do? Normal issue entry. This is the normal issue entry. Yeah. When issue is at premium, debenture application account debit, 2% debentures to securities premium. Yeah. So let's pass this entry. Normal issue entry. See here. Debenture application account debit. Yeah. Here it was credited. I debited it and cancelled it 110. Now this amount I have to take somewhere. Where do I have to take it? You know, we have to take it in percentage debentures account, only the face value, and then the remaining 10 rupees extra which we have received, that will go to securities premium. Isn't it? Isn't it? Like this only. See here, this entry we have to pass. 2% debentures account, only face value will go 100, and in securities premium 10 rupees that extra we have received will go. Is that clear? Okay. And then what you have to do, and then you have to see about the redemption elements and insert the redemption elements in this entry. Okay, that's what you have to do. Add the redemption elements. Okay, so redemption elements, how much extra we are paying? I mean, we are not paying right now, we will pay after 10 years, right? It's future thing. So 20 rupees extra we will pay. So that 20 rupees extra is a loss for the company and a liability. Let me just show you that conceptual thing. See here, redemption value is more than the face value. Let's just say 150 is the redemption value and face value is 100. 50 rupees extra we are paying in future. So this 50 rupees is a capital loss. I already explained this to you, but let me just explain to you again, right? So capital loss has to be recorded and written off over the life of the debentures. And then that 50 rupees has to be paid in future, right? So that 50 rupees is a liability also, right? We follow double entry system. We have to debit the loss and credit the liability. Yeah. If we just see the entry separately, then the entry will be like this: loss on issue of debentures account debit rupees 50 to premium on redemption of debentures account credit rupees 50. This entry we have to add. Yeah, this redemption element entry we have to add in the normal issue entry. See here, loss on issue of debenture account debit to premium on redemption of debentures account credit 2020. Is that clear? Yeah, you have to understand properly. Okay, students get confused regarding securities premium and premium on redemption of debenture. That's why I have made this separate slide and have explained this again to you. Yeah, why? Because understand, securities premium is the amount that you receive at the time of issue. Premium on redemption of debenture is the amount that you have to pay. Extra amount you have to pay, extra amount you have to receive. Okay, it's different. Is that clear? Never get confused in these two, right? Easy, right? You understood? First we pass the normal entry, debenture application to percentage debentures to securities premium, and then we inserted the redemption elements, right? Loss and the liability. Fine, you know the logic and everything, right? Losses are always debited, and then this is the liability increasing, you are crediting it, and then securities premium is a reserve and equity account. Whenever equity increases, you have to credit that, and premium on redemption is a liability which is increasing, you have to credit that. Is that clear? Simple and straightforward. You are done with the case 4 as well. Now let's move on to the case 5 of discount. That's gonna be more interesting. Now see here, we have the case 5. Debentures have been issued at discount and redeemable at par. Okay, let's just say, for example, the face value is rupees 100 and we are issuing it, the issue price is rupees 90, less than the face value. Yeah, we are going to receive just rupees 90 from our public, okay, from the debenture holders. 10 rupees less we are going to receive. Our debenture initial starting point original value is rupees 100, face value is rupees 100, and we are getting just 90, 10 rupees less. So that 10 rupee is a loss for us. and we have to record that loss right now only. Is that clear? Okay. And then see here, redemption value is rupees 100. Yeah, we are going to repay them back after 10 years at the face value only, at par only. Is that clear? So let's just see this in the flow chart. See here, the face value is rupees 100 and then issued at discount rupees 90, issue price is 90 and redeemable at par. Redemption value is rupees 100, case 5. Okay. So how are we going to pass the journal entry? The same way, really simple. For receipt of application money, yeah, lump sum assumption only, everything has been received at once. Bank account debit to debenture application, 90/90, because this is the amount we received, isn't it, per debenture? Yes. Now, I told you we always transfer face value to the percentage debentures account, isn't it? Yes, I told you that, right? So see here, for transfer of application money to debentures account, what we'll have to do, see, debenture application account will be debited by 90. It will be debited by 90 because here it was credited by 90. I debited it and I cancelled it off. And then 90 I cannot transfer to percentage debentures. No, it doesn't work that way. I have to take the face value only. Okay. So I will credit the percentage debentures account by the face value, because that's the rule. Always face value will go in percentage debentures account. Like how in issue of shares chapter, only face value used to go in equity share capital account. Similarly, here also it's like that. Okay. So now what about the mismatch? 100 and here 90. The mismatch, that 10 rupees difference will be the discount, the loss which we are bearing as a company. Discount on issue of debentures account. Okay. So that 10 rupees gap or that 10 rupees mismatch will be completed by a debit of discount on issue of debentures account. Is that clear? This is also a capital loss. This also has to be written off by, written off over the life of the debentures. Is that clear? Fine. So you understood the entry over here, debenture application account debit 90, discount on issue of debentures account debit 10, 2% debentures account 100. Let's just say, for example, issue price was 70. Then how much would have been the discount? 30. Okay. 70 will come over here and then debenture application 70 and then discount will be 30. But in percentage debentures, 100 will only go. Okay. Whatever the face value is, the complete face value will go. Is that clear? You understood this? Really simple. Okay. This is a capital loss. To record the losses, what do? We debit that. Is that clear? So this is a simple case. The same thing you have seen in issue of shares chapter as well, isn't it? Yes, you have seen this. Okay. So you have understood the case 5 as well. Now let's move on to the case 6. Now see here we have the case 6. Debentures have been issued at discount and redeemable at premium. For example, let's just say the face value is rupees 100 and the issue price is rupees 90. Of course, less than the face value because debentures have been issued at discount. So we are going to receive only 90 rupees from our debenture holders, 10 rupees less. So that 10 rupees less short, that 10 rupee will be our loss which we are bearing because our debenture is of 100. We are giving it away for 90. So 10 rupees loss. And you know how to record that loss. Yeah, you have seen the case 5. Discount on issue of debentures, we debit that. Yeah, debit all losses, isn't it? Yeah. And then redemption value is rupees 120, more than the face value because it is happening at premium, redeemable at premium. So 20 rupees extra we are going to pay in future after 10 years. Is that clear? Yes. So 20 rupees is what? Loss on issue of debentures. Understood. Now let's see this in the flow chart. See here, face value is rupees 100 and then issue price is at 90. Yeah, 90, and then redeemable at a premium 120. Yeah. 100, 90, 120, 100, 90, 120. The last case, case 6. Again, this is the most complicated, you can say, and the most confusing for the students. But it's really simple. Don't worry. I will teach you how simple it is. See, how will you pass the entry? The same way, the same assumption. All the money has been received in lump sum. All money entirely at once. Okay. So for receipt of application money, what money you will receive? Issue price amount, isn't it? Yes. So bank account debit to debenture application 90/90, isn't it? Yeah. And then you have to transfer to the percentage debentures account, the second entry. Yeah. But here in this case you have redemption elements, because redemption, yeah, is happening at premium, redeemable at premium. Whenever redemption is at premium, you know there will be redemption elements. Yeah, 20 rupees extra we have to pay. So that extra thing is what? Loss on issue of debenture, and at the same time we have to pay in future. It's also liability. Yeah, double entry system we are following. We can't just record loss and leave it as it is. No, we have to record both the things, loss as well as the payment that we have to make in future. Is that clear? Okay, fine. So this will be debited, this will be credited, you know that. But we have to strictly follow the technique. The technique is, first we are going to pass the normal issue entry. Normal issue entry you can see in the case 5. Yeah, in the case 5 you see this is the normal issue entry of discount. Whenever we have discount, normal issue entry is this: debenture application account debit, discount on issue of debenture account debit, 2% debentures account 90, 10, 100. And the same figures I have used over here, yeah, 100 and 90, right? So the same sort of entry you have to pass. Yeah, then after passing this entry you have to insert the redemption elements, a debit of loss and a credit of this premium on redemption. Is that clear? Yeah, you can easily do this. See here, let me show you. First let's pass the normal entry. Yeah, you will cancel the debenture application account as usual, debit 90, and then you will record the discount on issue of debentures. Yeah, rupees 10, isn't it? Debenture application account 90, discount on issue of debentures 10, and then you are going to transfer this rupees 100 to where? To percentage debentures account. Yeah, the face value. The face value will go to percentage debentures account. Is this clear? Normal entry you have passed: debenture application debit, discount debit, 2% debentures account. Yeah, the same entry you have passed, same like case 5, no difference at all. Yeah, this entry only you have passed. After this you have to insert the redemption element, loss on issue of debentures and premium on redemption of debentures. How will you come to know the figures of this redemption element? It's really simple. Always remember this. Just compare the redemption value with the face value. 120 minus 100. Always this, okay? Don't subtract 120 with 90 or something like that. Most of the students make this mistake, okay? They just subtract 120 with 90 and they come to know it's 30, or maybe they set off the loss and they make mistakes. So that's why always compare the prices with the face value only. Face value is the barometer. I told you in the concept also, face value is the barometer. Just compare with the face value. So 120 minus 100, 20 extra you are paying, so that 20 is the loss for you. Loss on issue of debentures 20, okay? And then here premium on redemption of debenture account 20. Fine, this entry you are passing. Which entry? See here, yeah, right? Loss on issue of debenture to premium on redemption of debenture. This entry you are inserting over here. Is it clear? Because that's what you have to do. As per the conservatism concept, prudence concept, you have to book the loss right now only, because you definitely know that this loss is going to happen after 10 years, right? And then liability also, premium and redemption of debenture, you definitely know you will have to pay in future, right? So that's why you're recording this liability also right now only. Is it clear? Fine. So you understood this entry. Really simple now. See here, 90, 10, 20, and then 120. Yeah. Here also it's 120. Here also if you add, it's 120. It's matching up. It has to match up. Debit has to be equal to credit. Yeah. Yes. So you understand how premium on redemption of debenture is what? It is the extra amount we have to pay in future. And at the same time, securities premium is the extra amount we already received at the time of issue. There is a difference. Here we have already received securities premium, I'm talking about capital profit. Whereas this extra amount to be paid in future. That's why this is a capital loss and a liability. Is it clear? That's the difference. Don't get confused between those two. Okay. Now one more thing. This discount on issue of debenture and this loss on issue of debentures can be combined as just loss on issue of debenture also. This also you can do. Okay. You can take this entirely together as 30, but I don't like to do that. I keep it separate because it is good presentation. You are keeping everything separate, but in the study material and everywhere you will find it combined. So that's also fine, completely fine. Okay, it's up to you. Don't worry. Fine. So you understood this. Okay. So if we see over here, then I want to explain you something. See here, In the flow chart, whenever redemption is there at premium, what will happen? You will have to strictly follow the technique. First pass the normal issue entry and then add the redemption element. Yeah, whenever you have case 2, case 4 and case 6. Yeah, we have seen. Yeah, I have shown you that. See, in this dark ink I have written the insertion of the redemption elements in all those complicated cases. Yeah, case 2, case 4 and case 6. Fine. And then in the case 5 also what will happen is you will have a discount. Yeah, in case 5 also you will have a discount. Yeah, discount on issue of debentures. So this also has to be written off. Okay, this also has to be written off. We'll see that at last. Okay, when we will learn writing off loss and discount on issue of debentures, at that time we'll see, you know, 4 cases will be there: case 2, case 4, case 5 and case 6. Okay, where we'll have to do the writing off. Is that clear? But redemption elements thing, this loss on issue and premium redemption, this will only happen in 3 cases: case 2, case 4 and case 6. Is that clear? Okay, so I think that's all. You have understood everything. From the next video we can solve the problems and, you know, practice everything, right? So as you know, we have so many topics to cover, right? So we have understood these 6 cases. Yeah, so we have to solve many problems on this to perfect this, and then we have to move on to consideration other than cash. Yeah, and then for collateral securities, they are very simple topics. Interest also very simple, and then this is little bit difficult, writing off discount or loss on issue of debentures. Yeah, it looks complicated, it looks difficult, but it's not really. We will tackle this. Okay, yeah, so that's all for this video. I think you have understood each and everything right now of the concept. Yeah, issue of debentures. Yeah, if you see this once again, and yeah, if you just read this and also the study material, you will understand lots of things after watching this video. Okay, so I think that's all for this video. Yeah, see you in the next video. Bye.